So it's been 1 year since the CCP has basically come in and crashed Alibaba's stock to the ground. So in this video, I'm going to be doing an Alibaba stock analysis and also look at some China GDP numbers. So it's only fitting for me to do a Alibaba video about time now, because I have actually been talking about China a lot, but never really talking about Alibaba. And I think this is like one of the centerpieces of all the debacles right now. So without further ado, this video is going to be once again focused on Alibaba's stock analysis and also China GDP numbers. But quickly, before I get into the video, none of this is financial advice. This is purely my own opinion. Please do your own research before making any financial decisions, because at the end of the day, it's your money and you have to be responsible for your own money. Don't just buy some stock because some guy on the internet said you should. So quickly, just to get into it, what does Alibaba do? This is basically a very basic question, but for those people that don't know, my favorite quote to answer this question is, if you can't explain to a 10-year-old why you should own a stock, you shouldn't own it. And basically, I'm going to take it a step further, which I'm pretty sure Peter Lynch mentioned, is that you have to explain it in 5 minutes or something like that. But basically, I can explain in 1 minute what Alibaba does. And basically, what Alibaba does is it's a primarily it's a Chinese e-commerce company that is looking to expand into Asia, and also looking to build infrastructure around their e-commerce arm. And basically, why it's classified as an e-commerce company is basically, you can see that about 80% of their revenue actually comes from e-commerce. You can see that China commerce accounts for 66%, and then you can add all this up. So how are they increasing their reach of their e-commerce business? Is basically they're investing heavily into logistics services, such as this China logistics service now accounts for 6%, and also cloud computing. So you can see that they are taking a very Amazon approach like method to basically grow out their whole ecosystem, and most companies follow this approach now. So we've already broken down the Alibaba revenue. So now we're gonna take a look at the discounted cash flow model. So actually, the reason we're looking into the discounted cash flow model early is to take a look at just based on financials, because actually I wanted to explain a lot of the nuances first, but I think it's more important we look at the numbers and we try to stay objective, and then I will talk about it, because something was supposed to be together. I'll explain it later. So this is a discounted cash flow model, and basically I'm going to assume that they will have so this is the base case, which is like a normal case. Scenario 2 is the best case, and third is the worst case, and you come up with a sum after that. So I use a 20% growth rate over the next 5 years and 18% in the next 5 to 10 years, and I use a discount rate of 20%. So what is a discount rate? Discount rate is basically what you want to earn from the stock. If I'm looking for stocks that only can have 20% upside annually, and some people might say, that's crazy, why are you looking for 20%? And I think that if we take stringent approaches, then we have less losing bets. And you know what Warren Buffett says, you only need a few stocks. You don't need every stock of yours to perform very well. So some people might use a 10% discount rate or lower discount rate. So I always use a 20% discount rate, because that's what I'm looking for. So terminal multiple in the normal case would be 25, basically how much the business is worth when it's normal time. Basically the PE ratio. Then this is the best case for me. The growth rate is 27% for the next 5 years, 25% for the 5 to 10 years. And all these numbers I didn't pull out of thin air. I went to try and research it to the best of my ability. But again, discounted cash flow models are just trying to predict the future. So at the end of the day, it's kind of just, a prediction and a forecast kind of thing, because a lot of things can affect business within this 5 to 10 years. And the worst case is a growth rate of 50% and 10% in 5 to 10 years, which is actually a very low number, but just because we want to see what is the worst possible scenario, right? So you can see that even in the worst case, the downside is only about $20 But of course, you have to count that your capital is stuck there. And so a few things here. Numbers are in USD. So this is a free cash flow discounted cash flow analysis. It's on market value. So market cap value, and also 25% margin of safety. Actually, it's not a market cap value, it's a per share value. Sorry. I'll change that. Never mind, I'll change it now. So we can see that the cash flow per share is about free cash flow per share is about 9.11. And basically, after all my analysis, we can see that we come down to actually we get this sum after we these three things are okay. Probability is basically that this base case has a 0.5 probability, and these two cases have a 25% chance. So you add it all up and you divide and you get an average. And basically you get $237. And after you get that $237, what I do is I add in the book value per share. So $52.48, and you get this. You get this F26, which is, let me just show the formula. So basically this times 0.75, and basically why I times 0.75 is because you can already say you're using a 20% discount rate and you're still discounting another 25%. So another 25% is my margin of safety. Sorry if I got that a bit confusing. And basically what this margin of safety and this high discount rate is, because the high discount rate is because I want to earn 20% on my money. And if not, I'm not willing to outlay investment like this. And yeah, stringent measures will make you have less losers basically. And this 25% margin of safety is just a discount for me to, unless I'm too stupid to basically predict all this thing, which everyone should have a big margin of safety. And you can see that you come down to a per share value of $230, and today's share price is 166. So actually, if it was below 230, I would have already started buying. But because I saw a lot of headwinds coming, which I will get into after this as well, so I didn't rush into it. Like a lot of people were rushing into it here, because they might use a 10% discount rate as well, right? So let me show you, if you use a 10% discount rate, what's the difference? So you can see that the price actually nearly double or triple. Not triple, but two times basically if you use a 10% discount rate. So personally, I like to take the more pessimistic view. So even if I'm wrong, I still make money, right? So yeah, next, a bit of a rant there. So next, Alibaba investment. So investing into black box. This is something that a lot of people are complaining about because of the lack of transparency and all the valuations of this basically loss-making companies, because every company nowadays basically starts as a loss-making company and then they grow into a profitable company. So we can see that Alibaba has all these investments. I don't have the time to go through it. You can take a look at it here also. All these investments that basically are not profitable or have no clear signs of how they are going to be profitable. And to that, I will say that, I don't really care about it as long as my discounted cash flow model says that, it's $230 based on current cash flow. That means I've already paid for the loss-making businesses. So in the event that even all these loss-making businesses will go and IPO, basically it's just a cherry on top, right? Because I've already factored it in my calculations. So next, we're gonna look at the famous Alibaba versus Amazon comparison. And basically, I'm going to focus on the cloud section because if any of you don't know, Amazon Web Services actually accounts for about 27% of Amazon's profits. So they are this huge company, but this small segment of their business actually produces most of the profits, because all these cloud services have very high margins, right? Basically up to like 80% or 70%, something like that. And basically, I'm just going to be bold and say Alibaba Cloud is not coming anywhere close to how big Amazon Web Services is, because first of all, Amazon Web Services has a huge early mover advantage, and they can do business with the government, they can do business with everyone basically, right? And I would foresee that Alibaba Cloud, due to national security reasons, first of all, they can't even do business with their own government now, and second of all, I doubt a lot of more of the Western counterparts will really trust Alibaba Cloud. So basically, I think it will be more used in the Southeast Asian region, not really like Amazon Web Services, which are basically used globally now, right? Even Asian countries, we will use Amazon Web Services. But I think this Alibaba Cloud is also competition for Amazon Web Services, and it will chip away at their market share as well. So next, I'm going to talk about the risk of investing in Alibaba, right? Delisting risk, regulation risk, China slowdown, and competition, and the VIE structure. So basically, the first one, delisting risk, is basically the US government said that in 2 years or 3 years, I think it's 2 years now, if you don't give us your accounting, you don't use our way of accounting, and you don't let our accountants go through your books, basically we will delist the Chinese stock from the New York Stock Exchange, right? And to my knowledge, Alibaba uses GAAP accounting, means generally, I don't know the full, wait, let me just Google it. So it's GAAP accounting. So it's generally accepted accounting principles, yeah. So they use this accounting method. So I don't see the delisting risk as a huge risk. So regulation risk, basically this is coming from the Chinese government. So I think this 4 is more important. The VIEs, sorry, I'll just go through one by one. So regulation risk is basically the government is saying that, we're going to clamp down on all these companies, which they have done in the past year. But I think this is about the tail end of it already, because they have already gone sector by sector, and now they are cracking down on fintech, more of fintech style companies, right? So we will see there'll be more crackdowns in the future for sure. So China slowdown. I just want to take your attention to the China GDP, 4.9% in the third quarter. So hate to flex, but I actually have a video about 1 week ago where I was seeing all this property developers having a lot of issues, and I predicted that in the next coming years, maybe 1 or 2 years, we will see China in a recession, because they have pulled a lot of growth from the future already due to construction, and now no one is staying in the houses and all things like that, and they are speculating on the houses. So we will see in 1 or 2 years, right? Maybe I can flex again. So second is competition. So I think this is one of the most feared factors for me, because you can see that Pinduoduo, JD.com, this is just in China. Amazon is in China as well. VIP Shop, Koala, a lot of the Tmall and Taobao is owned by Alibaba. So a lot of these e-commerce players are basically going to pop out left and right, because this is the new way of doing business, and this is very profitable. Everyone has seen Amazon and their success story, and everyone wants to participate basically. So that is only the China competition. So we can go to the next, which is Shopee. This is a very big competition coming out from Singapore, competing with Alibaba's Lazada. And next is Amazon, right? So recently I've been seeing on my Facebook a lot of Amazon ads, and basically I know that if I'm seeing a lot of Amazon ads, so are the people that are around me, and basically I live in Southeast Asia. So basically Amazon is wanting to come in and take business in Southeast Asia, and they have already been competing in India, but now they are even expanding to a niche country like mine. So I live in a country beside Singapore, and it's Malaysia. So we can see that even small countries like ours, they are looking to take market share. Means competition will be very harsh, right, in the coming years. And the last but not least is the VIE structure. This VIE structure is basically, you are not actually buying Alibaba when you're buying the stock, because you are buying some Cayman Island entity that owns the rights to the profits of the company. It's very complicated. You can just YouTube it. There's a lot of good videos explaining it already. So my conclusion, Alibaba is a fantastic buy right now, today, at $166, but there is no rush to dive in. For me personally, I would take a slow and steady approach. We can start accumulating shares right now, and there are huge headwinds coming up. As you can see, the China GDP numbers are not looking good. The Evergrande fiasco, if anyone doesn't know about it, is also not looking good, and that may present more opportunities in the future to buy the dip, right? So one of the reasons that I took so long to even make a first video on this is a quote that I read, which is from I don't know who it's from, but it's from a very good investor. And basically it says that you have more time than you think when you see a good opportunity, because as you can see, a lot of people, the moment the crackdown hit, right, then they're like, it's somewhere here, and they're like, oh my god, we need to buy in now, and you can see that from there it's gone down a lot, right? So patience is a virtue in this game. If you can be patient, yeah, I'm sure sometimes you'll miss big opportunities because you're too patient. But if you're not patient enough and you try to buy it here because you think, you know, it's a good idea, you might have panic sold by the time it's somewhere here or something. You're asking yourself, why didn't it go up? And now you have a better opportunity to buy at a much lower price, and it increases your upside exponentially, right? So yeah, that's all I wanted to share today. So quite a lengthy video today. Hope you guys enjoyed. Yeah, if you enjoyed, don't forget to help me smash up the thumbs up button, hit the subscribe button, and hit the bell button. And with that being said, see you on the next video. Thank you very much for watching till the very end, and peace out.